Okay, this last lesson in this unit is kind of self-explanatory because it's sort of all written out. So basically, just to summarize, when we were doing preparing for a budget, we talked about setting aside 10% of your net income. And the question is, what do you want to do with that 10%? Yeah, you want to save it, but how? There's really two types of bank accounts. There's sort of there's some hybrid stuff and there's also online stuff. But really when it comes down to it, there are checking accounts and savings accounts. And depending on what you want to do with your money, each of these has advantages and disadvantages. A checking account is usually an account that you get little interest for, if any. So I have a checking account at TD and I get no interest on it. So what do I use it for? I only use it when I want to spend money. If I want to pay for something by debit, if I want to e-transfer an amount to somebody, if I want to write a check to somebody, okay? That's when I would use a checking account because, and then often checking accounts, you won't have to pay transaction fees. That means every time you do a transaction, you may have to pay a fee. But mine, you don't have to, okay? As long as I keep at least $3,000 in that account. So the minimum balance is $3,000 bucks. If I keep a minimum balance of $3,000, it shows me how much I get charged per month for fees, but then it gives me a rebate because I've kept a minimum balance. But I'm not making any money by interest. So that's sort of the advantage and disadvantage of checking accounts. It's easy access to cash and payment, okay? But you can get little to no interest on it. So you're not building any kind of amount of money in it. And depending on the minimum monthly balance, you may have to pay fees. Like if I didn't keep a minimum balance of $3,000, I'd be paying $30 a month in fees. Because usually when it shows me how much I would pay, it's around $30, but then I get that credited back because I've maintained a minimum balance that they want. And different types of checking accounts that you see here, joint checking accounts if you're common law or married, student checking accounts, if you do transactions in US dollars, there's a US dollar checking account, business checking account is separated from personal, okay? But some questions to ask and some things to think about. When you open a checking account, first thing you want to ask is, okay, do I get any interest on it? If I maintain a certain amount in there, and chances are it'll be little to none. Okay. Do I get unlimited transactions, or do I only get a certain amount of transactions and then you start charging me for every transaction? Because I mean, like, how many times, on average, would you say how many times do you guys use your debit card in a day? 4 or 5. I'm about the same, around 4 or 5. Like I don't even carry cash anymore. I just use a debit card. So that's something that's really important to me, that I want to make sure the account that I'm taking out by using my debit card, I'm not getting charged per transaction because I could end up paying a lot in fees. And like I said, mine is unlimited transactions as long as I maintain a minimum balance. And which is another thing you want to ask about. You want to ask the transaction fees, minimum balance, okay? And things that you want to consider, determine the number of transactions you make each month, see if the checking account matches up with that so you're not going to have to pay fees, sort of what I've already talked about. You may want to consider online-only banks and credit unions, which tend to offer free or low-fee checking options. But the only problems with those, with online banks and credit unions, is that if you go to different ATMs to get cash, you may be charged an ATM fee if you're not using one of your institution's ATMs, and online wouldn't have any ATMs. If you want to save your money, if you want to build some interest that we talked about, okay, oh, sorry, jumped ahead of myself. Like I said, one thing you can do with a checking account, in addition, and you usually get these when you open a checking account. You'll get a set of checks, okay? Most companies now, like a lot of times if you had repair companies come out or something like that, you would often have to pay by check because they didn't have the technology. But now pretty much all of them have the technology. So you could pay by credit card or you could pay by debit. Checks probably aren't as important as they used to be, but you still get them because you never know. It's good to have in case you absolutely need it. So most checks look like this. You've got a spot in the upper left. This is usually printed for you, like your name and address and everything is printed for you. The date that you want to write the check, who you want to write the check to, and the amount. Then you got to write the amount in words. This you don't have to fill in, the memo. The memo simply means what are you paying for? People do that just for their own records. But you don't, if this isn't filled in, it's not, the check will still go. But you do have to sign it as well. And then at the bottom of the check, you get a series of digits. So the first 3 are going to be your check number. The next 5 are going to be your branch number, where you opened your checking account, where you opened your checking account. The 3 after that are going to be your financial institution. So depending on your financial institution, like there's 5 big banks in Canada. So 001 represents Bank of Montreal. 004 represents TD. Then there's also RBC. Then there's also Scotiabank. And there's also CIBC. Those are sort of the 5 big banks in Canada. Designation number, I even did a search on this. It's kind of a useless number, right? But the account number is not. That's your checking account number. So, pretty straightforward, but how do you write a check? Well, like I said, let's write a check. So I would put my information up here. You would put yours. I'll just put 123 Anywhere Street. Winnipeg, Manitoba. I'll just do shorthand, WPG, Manitoba, and then just toss in a postal code. Like I said, this will be used when if you get your own personalized checks, that'll be printed for you. You don't have to write that out every time. So today's date, January 18th. $2023. We are paying to the order of Dominion Automotive. And the amount that we are paying is $274.95. Then you've got to write the dollar portion in words. The cents portion you can just put here. So that represents the 95 cents. Then we would write 274. 274. You don't have to write dollars because it's dollars at the end. Again, the memo, you could say, if it's for repairs or something, you could write that in, and then you sign it. What happens if you make a mistake on a check? What happens if you're writing out a check and you accidentally write the wrong date, or you write the wrong amount, say something there? What's that? You could write a new one. Or sometimes what you can do is if it's a minor mistake, you can change it, but you have to initial it. So like, let's say I wanted the check for January 19th. So I could do this, but then I've got to initial it because that indicates that I know that I made the change. Okay. But I mean, if you completely butcher a check, then yeah, you're best just to write it over again. It's not like they take a long time to do. But that's essentially what a check looks like and how we write a check. Now, the other type of account, savings accounts. This is where you want to put your money if you want to keep it there for a while and you want it to build interest. We don't use savings accounts for everyday transactions. So I strongly suggest you might want to look at that to see. I mean, if you're getting a really good interest rate, okay. And if you're not getting charged transaction fees, okay. I'd be a little surprised, but you never know. So this is when we want to keep our money. We don't want our money to be, and this is a business term, liquid. Liquidity refers to how quickly can you transfer or change your money into cash? Like how quickly can you get it out of an account and into cash? Sometimes it's not so easy because you may be locked in for something, or you may get taxed on something. So different types of savings accounts. You got a high interest savings account, joint savings account. Registered savings accounts help you avoid taxes. Because there are other accounts, savings accounts that you could put your money in, but many times you'll get charged on the amount, you'll get charged tax on the amount that you make in interest. However, with some accounts, like a tax-free savings account, you can put money in there, it'll grow, but you can only put up to a certain limit. Everybody has a different limit. After that limit, you'll get charged tax on it. But if you're under that limit, you got a savings account there, it's growing, and you're not getting charged tax on it. A registered retirement savings account or plan is exactly what it means for retirement. So what happens with those is you can save in those and you won't get charged any tax because it's a tax exempt. In fact, you can get refunds. Every year, you can donate a certain amount to your RRSPs. It's not unlimited. So for me, I can put $6,000 a year in RRSPs. That's the maximum. If I put that maximum in at tax time, I'll get 40% of that money back as a rebate, as a refund for RRSPs, which is very nice because it kind of allows you to reinvest or to save for something. However, it's a retirement savings plan. So if you start to take money out of that, you get taxed heavily. So there's advantages and disadvantages to it. So savings accounts, I mean, they can earn interest, not good for day-to-day stuff, okay? If you're gonna be changing your account balance all the time, and you gotta be careful in terms of, you know, is the interest that you're getting, is it going to be taxed or is it not going to be taxed? And some questions to ask, some things to consider. Obviously, you want to know the interest rates. Interest rates vary a lot depending on where you go to, okay? And it could vary on how much is in the account. It could also vary on how long you leave it in the account. I went to Cambrian the other day, where is it? And I saw their, where did I see here? Oh, I hope I have it. There we go. Savings rates. So like they're called GIC RRSP, RRIF, TFSA, those are just different types of savings accounts. So for 1 year, if it's in 1 year, it's 4%, and then it keeps going up. If it's in for 5 years, it can get up to 5%. So that's just one institution. Okay. So that's this one bases on how long you're going to keep your money in. Your interest rate can change. Okay. But I mean, all you have to do is just go and look up one of the 5 big banks or a credit union if you want, and then just look under products and look under their savings and checkings account. I've actually asked you to do that in exercise 3.3. And this last section just sort of deals with some types of bank fees and charges you could see that I've already referred to, like a monthly fee, transaction fees. If you want to get a statement, a paper statement, you could end up paying a fee for it. ATM fees, especially if you use an ATM that's not your own bank or not your own institution. Non-sufficient funds or overdraft fees, okay? If you don't have what happens if you don't have enough money in your account and you try to pay for something. And then e-transfer fees, some you get them free, some you have to pay for them. But those are just different examples of fees that you could see.